Hi, my name is Jim Evans, President of Gannon Wealth Security Partners. Thank you for taking some time out of your day to watch our video. Our videos are to help you understand the strategies you need to help protect you, your family, your business, and future generations. Those strategies will be all wrapped around retirement planning, estate planning, tax mitigation, and asset protection. I hope you enjoyed today's video. Please don't forget, subscribe to our YouTube channel, follow us on Twitter, like us on Facebook, and make sure you leave comments below so that we know exactly what you want to know. That's what we're here for. Thanks again, and enjoy today's video. Hi everyone, and welcome back to the show. My name is Jim Evans, President of Gannon Wealth Security Partners, and today we are talking about universal life contracts. Last week I got an email asking me if there was a life insurance policy that you could continue to pay the premium in full on time and still have the policy lapse. That individual was talking about a universal life contract. Those are the ones you have to be very careful with. They're not a bad product. They could fit an absolutely great need, but you have to look at them on a regular basis. You have to work with your advisory team to make sure they're still performing up to par. So we're going to jump right into it. Universal life contracts. So I took the liberty of starting to draw some stuff out to keep the video a little bit shorter, but I want to go through everything before we get started actually looking at the diagram. So the cost of insurance is very, very important with universal life contracts. The cost of insurance is the actual cost the insurance company imposes to insure your life for that death benefit. So when it comes to a term policy, you're really only paying the amount that it costs in order to insure you, right? So if you could think of the same thing here, it's kind of like buying a term policy is the cost of insurance. That is the amount that it actually costs for that death benefit. Then we have this other thing called the side account, okay? And we're going to get to what that is in a minute. Funds collected above the cost of insurance. So when I come over to my diagram here, let me grab a marker. We'll go with blue today, okay? So we have the axis, right? We have our premium. So this is our premium in dollars. And then we have the years of the policy. So this is our years. Okay. So the first thing we're going to look at is the cost of insurance. When you look at this graph, you're going to see that the cost of insurance is going to rise over time. If you go back to a video that we did earlier this week on term life insurance, if you remember, there's two different types. There's level term, and then there's yearly renewable term or annual renewable term. It functions very similar to that, because the cost of insurance is going to rise slightly every single year because you are closer to your death. Every year you get older, you're closer to that. So that's why the cost of insurance goes up. So this cost of insurance is going to rise gradually over time, and then towards the end, so let's say for instance, this person was 40 years old when they purchased the policy. They're 45, it may have climbed a little bit. When they're 50, it starts climbing a little bit higher. When they're 55, it starts, even the incline is going even steeper. And then when you go out here to 65 and 70, this is going dramatically higher, right? So each year the cost of insurance is getting higher. Now, a universal life contract is also called a flexible premium product. And the reason for that is you have flexibility of paying your premium. Has anybody ever heard their parents, or even you might have one of these policies yourself, and you say, oh, I don't have to pay this year because the policy is performing so well that it pays my premium for me. It may be one of these products. It might be a whole life product, it's possible, but more likely than not, it's one of these products because it has a flexible premium attribute to it, okay? So normally what happens is your advisor will do an illustration at paying this premium level, and then that person pays either monthly, quarterly, semi-annually, or annually every year that amount. So what happens is you have this little gap here, right? This gap is the amount of money that you're paying over the cost of insurance. So that money here is going to go into the side account, and it's going to build up. So if this is our side account, it's going to grow over the years that you're paying additional over the cost of insurance. Now, this is an unbundled product, which means when you get your statement, you're going to see the cost of insurance rising, you're going to see your side account, you're going to see the policy performance. It may take an advisor, a professional, to review that policy and help you out with it, but everything is in there. The information is there. Okay, so the issue becomes is when you get to here. So let's say this is year 18, and again, it's going to be different depending on, like I should say, these side accounts normally follow an index. Okay, so they're principally protected, but they follow an index. So when the advisor does the illustration way back here, when you first buy it, they do an illustration on what they believe is going to happen. Well, we've been in a very low interest rate environment for a very, very long time. Okay, so almost 10 years of this has been a low interest rate environment. So these may not have performed as well over the last couple of years. You want to take a look at these if you have a universal life contract. Okay, so this additional money is going into here and the money is rising. You get to here and now you are paying the exact amount of cost of insurance. So nothing is going into the side account that year. Now what's going to happen in additional years is you're paying less than the cost of insurance. So what's going to happen is your insurance company is not going to call you and say, hey, you need to put more money in this policy. What they're going to do on your behalf is they're going to take money and supplement out of the side account whatever the difference is. So let's say this is $400 a month, and here the cost of insurance is now $500 a month. What your policy is going to do is going to supplement that additional $100. The problem is the cost of insurance is going to keep on going up, 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 up. So here it might be 100, 200, 300, 400, 500. And now what's going to happen is you may come to a point where you have zero in the side account. Well, when you have zero in the side account and your cost of insurance is higher than the premium that you're paying, well, that could be an issue. What's going to happen is the insurance company is going to call you or send you a letter, more likely than not, they're going to send you a letter, and they're going to say, Mr. or Mrs. Jones, you need to send us X amount of dollars to keep your policy enforced. This scares the bejesus out of people, okay? Because they're like, well, but I've been paying this entire time. I had no idea. I haven't looked at it. I haven't reviewed. My agent didn't call me. My financial advisor didn't call me. You didn't call me. You should have told me earlier. Now I have to pay $1,800 this month. This is ridiculous. And the policy lapses and they lose the coverage. So with this type of policy, almost more than any other type of policy, you need to review it at least on an annual basis. Because what you can do is you can run an as-is illustration. So, for instance, let's say you have one of these policies and you're in year 10. Well, in year 10, you've had the policy for 10 years, right? In year 10, you order an as-is illustration. And what that's doing, and the carrier is going to send you this illustration. It's going to say, okay, if the things continue to go the way they've been going, this policy may lapse in year 21. Well, there's a couple solutions to that. One, you can take any money that's still left in that policy and you can 1035 it over into a new policy, right? A different type of policy. You could do that. Or it may be just as simple is raising the premium to here. This may make a world of difference. So now you could turn around and you could say, okay, carrier, whether that's Guardian or Mass Mutual or MetLife or New York Life or whoever it is, you could turn around to them and say, hey, listen, what if I gave you just a little bit more? What would my as-is illustration look then? What would the future of this policy look then? And then from there, you can make an educated decision for you on whether or not you're going to keep the policy or you're not going to keep the policy. The issue here is a lot of people call this a permanent policy. And even in my book, this is classified as a permanent policy. Okay? There's no term where it's just going to end. However, it's not as permanent as some other policies. When you look at a GUL or a whole life policy, those are pretty permanent. You pay for a certain period of time, boom, you have that death benefit. Here, you have to monitor a little bit more. So if you have one of these policies, go to your advisor, even if it's not us. I don't care. I just don't want to see people getting hurt, because now they're either getting a huge bill that they're not expecting, and what's even worse is they've now lost this protection here. And what's a real shame is when they lose that protection, that's normally around the age that is very, very, very important to them that they have the protection to either give to their children, their grandchildren, their charitable causes that they care and are endeared to. So that's just a quick one. Universal life contracts, if you have one, definitely review it. If you have questions, you can always give us a call, send us an email. Continue to follow us on Facebook, Twitter, like our page, subscribe to YouTube. We've had quite a few people subscribing to our YouTube channel, so that's telling me that you like what you're hearing and that you want more of it. So thank you. That means the world to us here at Gannon Wealth Security Partners. So again, until next time, we'll see you soon. Oh, hold on 1 second. I forgot to mention, we still have our $100 Visa gift card promotion going on, where you have to share today's post and comment on what you would like a future topic to be about, okay? So just want to throw that out there. I want to keep that going. September 6th, the contest ends. September 7th, I'm going to draw it live right here, post it so that everyone knows I did it live and I didn't just pick somebody, you know, at random, or one of my friends or one of your friends or so forth, okay? So thank you so much for your time, and we'll see you next time on our videos.